U.S. equities were trying their best to recover from the pullback low earlier this month, but we're seeing a different kind of price action these days that may even be unfamiliar to some of the younger traders out there. This is the type of price action when a market makes lower highs and lower lows. This is the type of price action where buy the dip doesn't have the same ring to it. This is also the type of price action that has been long overdue after seeing a decade run that had extended right up into recent days. It isn't economic data or earnings that are factoring into this price action either. All of this is about what is sure to happen when the market starts feeling the pains of monetary policy normalizations in the face of plenty of downside risk in the global economy. Investor immunity to such risk had prevented the market from declining since the rally got going in 2009, with that incentive of free money simply too sweet to ignore. But investors don't have that same kind of immunity anymore, and this is making the market a whole lot more nervous about existing downside risk, with valuations becoming less and less attractive as it is on account of the policy normalization. We believe there is still plenty more to go, and if we use the S&P 500 as a proxy, we would not be surprised if this pullback gravitated all the way back down to around 2100. This would imply a correction of some 30%. This may sound dramatic, but when you consider the fact that this would only take us back to record high levels from 2015, it becomes a little easier to see as a realistic possibility. As far as the currency side of things goes, the US dollar has been in demand in recent sessions, with the market trying to find comfort in the traditional safe haven. But we continue to warn against any expectation for a big run from here in the US dollar, and even see risk for the dollar to underperform against the other major currencies in light of the US administration's soft dollar policies and in light of what could be a Fed that starts to think about scaling back. Certainly, dollar weakness against the yen came through on Tuesday, with the yen already rallying on its traditional correlation with risk sentiment. The pound was also trying to make a push after some news hit the wires that the EU was willing to offer Theresa May a UK-wide customs arrangement. This more than offset early fallout from the discouraging UK CBI trends data. Elsewhere, the euro tried to recover off of its lows against the buck, perhaps getting some help from the hotter than expected German producer prices. Looking ahead, we get some central bank speak and a much busier Wednesday calendar that features German and Eurozone manufacturing PMIs, US manufacturing PMI reads, US new home sales, a Bank of Canada policy decision, and the Fed Beige Book. That's all for now.